Fed set to cut rates on Wednesday, and we're looking at rate cut for the first time here in 2025. In fact, we haven't had rate cuts in quite some time due to weak labor market is what is causing this. Now, what's interesting is that this is in the first time in a while that the Fed has cut near all-time highs, right? And we're seeing all-time highs happening as we speak. Valuations, however, for the S&P are also at record highs. They're surpassing the dot-com bubble of the year 2000. I think the dot-com bubble, valuations were around 3.2, 3.1, 3.2, and we're at 3.3 to 3.5, depending on how you calculate it, for valuations for the S&P. So the question I pose to myself, and now I want to pose to you, is what are the long-term or short-term results of rate cuts to the markets? And also, how can we as seasonal traders combine this information to get an idea of maybe not what the short-term markets look like, but what about the intermediate term as we head into the final quarter? And so I want to start off, and we got to blow this up. This is Carson Research did this. This is a spreadsheet of rate cuts going all the way back to 1980, okay? Now, what do these rate cuts have in common? Because there's a lot of rate cuts out there, but these specifically are rate cuts within 2% of an all-time high. So you've got 1980, you've got 83, couple cuts in 83, you got a couple cuts in 85, 86 had 3 rate cuts. 89, 90, you got 91, had 3 rate cuts in the year 1991. We had 2 more rate cuts in 92. We had a rate cut in 95, 96, and then we jump all the way to 2019, where we had 3 rate cuts in a row, right? Followed by our cuts in 24. So what happened afterwards? Okay, there's a lot of data on the screen. I want to clue you into right here what happened the following month after that rate cut. And I don't want to go through each one of these, but if you add all this up, the markets were basically flat. And that 50% number meant that a month later, the markets were either higher or lower, okay? So there were basically, out of all the data we saw, half of the time, the markets were higher, and half the time, the markets were lower. So that's a coin flip, okay? That's really not a pattern. So taking that information, we get a rate cut on Wednesday based on the historical moves of going all the way back to 1980. We've had 20 times that we've had rate cuts, or 22 times. Half of those times were up, half the time were down. Not a pattern. But let's look at the other side of the equation. How about next year? A year from now, every single one of these had these numbers that we had these moves higher. 100% of the time we had higher markets, all right, higher moves in the markets than the year prior to that particular rate cut. Okay, so short-term pains and long-term gains. And now, what does this do for the rules-based trader? Again, short-term pains and long-term gains can be taken into account, right? I can go through and I can look at data. And instead of me looking at, say, 30-day data, 20 to 40-day data, what if I were to push that out and look longer term? Now, I did this, and, when I'm looking at data involves everything that happens in the markets. It factors in everything, because everything we need to know as technical traders is already equated into the price of the stock and the volume, the trading volume that precedes the price. And so I wanted to adjust the calendar, and I want to show you what happened before and after when I adjust the calendar for September, and I want to focus on the big indices, and I want to show you what's shaking out right now over the next week. I know stock patterns have repeated the same movements at least 90% of the time over the last decade. I'm Tom Gentile, America's pattern trader, and I'll show you exactly what trades I'm watching this month and teach you how to aim for those triple-digit gains, all for just $9. Scan the QR code below to get started. What I see happening over the next week as a precursor to what I am doing later on this week to show you what's going on for the rest of the year. So here's what's going on. So this is the current 20 to 40 day calendar that I've been working with. And so the markets have been hitting all-time highs, but we're not melting up in the stock market. We're doing a little bit of this. So here we are coming into the 15th, and it's kind of a 50-50 week. And we start to get green next week, but the markets have not been pulling back. We haven't seen the 5% or double-digit pullback that many people were predicting. When I look at the money counter, Seasonality has been predicting for me that we are going to see some pullback in certain stocks. And that has happened for some stocks, but other stocks it has not happened for. So when I look at what's going on, after Labor Day, what if we made a simple change? What if we pushed ourselves out past the 30-day noise? So going from the 20 to 40-day trading calendar, I made a simple change to the data, and I changed it to a 30-60 day. And 30-60 day shows something completely different. At the beginning of the month, we were 60%, 2/3 bullish, 1/3 bearish. By the time we got into the second week, it was 70-30. Look where we are now, 83-17. Look at next week, 87-13. And now, I'm not saying that the stocks that I'm looking at have an 87% chance. No, to be on this calendar, you got to be 90% or higher. I'm saying, will you add up all the stocks that have a 90% or higher historical probability based on the last 10 years? 87% of those next week are bullish, and 13% of them are bearish patterns. Okay? So again, how did I get to this data? Well, I simply took all of the data on all of the stocks and all of the ETFs that I follow, and I said, instead of looking at the 30-day calendar, let's push it out a bit. I didn't even go that far. I went from 20 to 40 to 30 to 60. It wasn't like, I was going out to the 6-month or the 1-year patterns. I just want to make a simple change to get us out of the 30-day noise. Now, I decided to look at ETFs. And so I want to start with ETFs with you. So with the Fed lowering rates and about to turn on the printing presses, this is good news for the stock market. It may not be immediate good news, but if we could put ourselves out to the end of the year, you give yourselves more time to be right. You give yourself time to get past the potential sell the news dip that we've seen 50% of the time has happened. But going out farther, that 50% goes away. Now, while the 10-year patterns have mixed results on many ETFs, a few of them are tilting bearish, most are tilting bullish, and the oldest index ever tracked had the best track record for wins, better than the S&P and the NASDAQ. So going into the fourth quarter of this year, it's the Dow Jones Industrial Average that led the pack in fourth quarter bulls. So I looked at it, and I came up with a start date, and it's not today, unfortunately. But I want to get you ready. I want to get you ready for this. So starting on September 22nd, we have a pattern that puts us into mid-December. And it's a good-looking pattern. All right, again, for me to be sharing DIA with you, what has to happen? It has to have 90%. It has to be 9 of the last 10 years. It had to be positive. It had to have 5 years. Last 5 years had to be positive. There should not be a loser in the last 5 years of my 10-year pattern. What else? I like to see consistency. I like to see some really nice profitable moves. We've had big time profits in the Dow or in the S&P and the NASDAQ, but now it's time for the Dow to flip the script. And so going into the last quarter of the year, It looks like that script will be flipped starting September 22nd if history proves itself correct. Now, again, how do I get all this information? I started with just a few stocks, and then I expand this to the top 325 stocks and ETFs. I want a minimum of 10 years worth of data. It smooths out the highs and lows. I also want to know the patterns are consistent each year during the same. And I did this with the Dow. So when you look at this, this is all the patterns I pulled up for the Dow. See that one down there at the bottom? A 60-day trading pattern. That's the one I'm focusing on right now. So yeah, you can go back and you can see that there are also 59-day pattern, a 58, 57, 56, 55, 54, 53. Yeah, they're all there. The patterns start sooner, but the more robustness is on the pattern when we wait. And if we're going into a Fed watch, it makes more sense to wait out the potential Wednesday and maybe the Thursday and Friday to come along with it. If we get that move that I'm expecting we're going to get, right? The percentages we see just get that much better. The trade duration, the end date, a little bit longer, right? My accuracy column stays the same. That's fine. I need a minimum of 90%. My average trade profit gets incredibly better if I just be a little bit patient. And more importantly, the power meter is the highest of everything that we just looked at. Profits increase over time. So when you look at this bullish pattern, it kind of sets up like this. 2018 was the only year in this back test, in looking at all of this data, that was negative. If you remember 2018, I remember 2018, we went into the end of the year, and that was the worst quarter that we'd seen on record in some time. In fact, I remember most of it all happening in December. All right. You know, it's funny. We can always remember our worst months ever. It's hard to remember our best as traders if you do this over and over again. I can remember exactly where I was. I was at Disney World. I don't think I wanted to be there at that week because it didn't feel right. I mean, not just for me, but for the overall market. Didn't feel right. But that's what I remember in 2018. But look at the rest of the decade. All right, 15, 16, 17 had some great returns. There was a little bit of some kind of up and down ish in 19, 20, 21, but all positive. 2022 had its best year. 23, 24, not bad at all. But when you add it all up, this thing is pushing for something around 6% is what we're looking for. So that's the idea there. All right. So as we move forward, my action plan looks like this. Q4 represents the best quarter of the year to be bullish on the Dow Jones. I see a 6 to 7% projected return between October 1st and December 16th. Puts the Dow at around 490 to 500,000. And if you are a trader, if you are an option trader, then guess what? Looking at calls or looking at call spreads can only reduce your risk, reduce your cost. It can also juice those returns if they end up happening.